Hello everyone! Today I'm gonna talk about asset allocation and creating a well-diversified portfolio. Why is this important? Let me remind you the first rule of investing according to Warren Buffett. Rule number 1 says, never lose your money. And let me remind you the second rule of investing. Second rule is, never forget rule number 1. But when we talk about diversification, Warren Buffett is not the right person to quote. We will have to look at the advice of the so-called Leonardo da Vinci of investing, whose biggest genius is in that he can apply the rules of investing that I mentioned a few seconds ago. Yes, your guess is right. I'm talking about Ray Dalio, the founder of Bridgewater, which is one of the biggest hedge funds in the world with more than 160 billion US dollars on its edge. This amount is astonishing, considering that most of the big hedge funds in the world are considered with more than 30 billion US dollars. Ray is more than just a money manager. He is a master of markets and risks. There is a reason why the world's biggest players, from the huge pension funds to the large sovereign countries, are investing with Ray, and they are following his advices. Now let's sit at the feet of this economic master and let him take us on a journey. First, I want to talk about the all-weather strategy revealed in this book, Money Master the Game. Let us hear it in essence from the author himself, Tony Robbins.
To give money to Ray 10 years ago, you had to have a $5 billion net worth and a minimum of $100 million on the first day, or he wouldn't even talk to you. That was 10 years ago. Now, no matter how much money you have, he won't do it because he manages money for China, for countries, for giant pension funds. So I get a chance to meet Ray, and I did 15 hours of prep for that. Just like I want to be able to pitch and catch with him. I was very fortunate, found out that he'd listened to my tapes and was a fan of my work from years before. And so our 45 minutes went close to that 3-hour mark again. And at the end, I said to him, went back and forth. And he really enjoyed it, and I enjoyed it, obviously, learned so much. I said, Ray, I asked this to all these people, if you could never give any of your money to your children, and all you could give them was be a strategy, a plan, a portfolio that they could not only succeed with, but they wouldn't have all that ups and downs that make people get out of the market and lose. I said, what would it be? And he said, my all-weather portfolio. I've already designed it. All my money's in it. My kids' money, all the money that I have for contribution to society is in it. And he said, because I know I'm not going to be here forever, and I need something that's going to work in any market. And he said, I've worked it all the way back to 1925. I've tested it, and it makes money. And he said, I did it for myself for years, and now I do it for my clients. I said, explain it to me. So he explained it to me, and I'd done my homework. I knew a lot about it already. But at the end, I said, okay, Ray, you've really explained this. Brilliant. You're showing me why in 2008, people that had half their money in stocks and they thought they were safe, half their money in bonds, like everybody tells you, a balanced portfolio, they both lost money. He explained why. He explained how you could avoid that. But I said, Ray, you told me everything but the percentages. So it's like, bake this perfect chocolate cake. And he says, bring some chocolate, bring some sugar, use some dairy products, but you're not telling me the amounts. I said, he goes, Tony, that's my secret sauce. And they give me the whole 5 billion, 100 million. I go, I know, but you said you haven't taken money in 10 years. You're not going to take any money. The average person can't do it on their own. Help the average guy out. And I was teasing him, pushing him. And he goes, well, it's complex. I said, but I'll simplify it. He goes, well, there's leverage. I said, design one without leverage. The average person can do 15 minutes a year. And he goes, well, it wouldn't be perfect. I said, your idea of not perfect will be better than anybody else on earth.
Totally.
So he sits there and he starts scratching this thing out for me. And I'm like feeling this vibration in my body. It was just incredible. At the end, it was incredibly generous. We went and tested it, back tested it. So it means you compare it year by year, what it did. In reality, not hoping what it'd do, but back testing something for a year or 2 years or 5 years, one thing. We back tested it 75 years, the worst and the most volatile times in our history. And interestingly enough, it's right, 85% of the time it made money. And the few times it didn't, the average loss was 1.6%. The largest loss in 75 years was less than 4%, minus 3.5. And that was 2008 when the market from top to bottom was down 51%. And that's the most of the loss in 75 years, and the average return is just under 10%.
So what's the secret sauce of Ray Dalio? Let us break it down in numbers. First, you need 30% in stocks. Or you can choose some index funds for example, S&P 500 or any other one, just to diversify your portfolio further. That might sound low to you, but remember, stocks are 3 times more risky than the bonds. Then you need long-term government bonds. 15% in mid-term 7 to 10 years bonds and 40% in longer-term treasuries. Talking about 20 to 25 year bonds, because this counters the volatility of the stocks. And then we can round out the portfolio with 7.5% in gold and 7.5% in commodities. This will be the piece of your portfolio that will perform well during inflation, because some rapid inflation could hurt both stocks and bonds. And then the idea is to constantly rebalance your portfolio, at least once a year. So this means when one part of this portfolio performs really well and the price has gone up, then you have to sell this asset class and reinvest the profits into the other asset class which has gone down. On this way, you will sell when it's high and buy when it's low. So this is basically the concept of the all-weather portfolio. You can read more about this strategy in the Tony Robbins book Money Master the Game. I'll put a link in the description below. But then we have the pandemic, which is an absolute black swan event that no one could predict. We have all that money printing going around. We have the zero interest rates, the monetary policy, and I ask myself, is this all-weather portfolio still actual? How does it perform today? What would say Ray Dalio about this portfolio? Can he update it somehow?
I really believe that in this environment, most investors will think safe is cash, and that's tragic. So you can see that one has to think differently from one's habits. When one thinks cash is not a safe investment, it's a risky investment, that stocks and bonds are not the same as they were in the past. One has to think of the storehold of wealth concept rather than just equity returns. One has to think about balancing differently. All of these things that I'm bringing up are not commonly thought about. They're not part of the common experience of investing over the past many years. In order to understand the lessons of history and even what's more likely to take place, one has got to go back to periods that were analogous to this and to study those periods. And when we did that over the last 500 years, you could see that you don't know if you're going to see the depreciation of the value of money and the storehold of wealth. So all of a sudden that changes what you define as risk. You used to think cash as a riskless asset. Cash can be the most risky asset as it depreciates in value. And then you start to think about different asset classes and different locations. So that's what we're doing. When we think of what is the diversified portfolio for an easing that happens at that time, that's kind of a reflation portfolio. And how do you measure that in relationship to other things? Because I think the one thing that we could be confident is that the Federal Reserve and other central banks are not going to let an implosion happen without printing a lot of money.
So in essence, what Ray Dalio is telling us is that the government and central banks are influencing the markets more than ever. Monetary policy is a major driver. And with their influence, the price of the assets will go faster than the expected return of investments. So this means every asset class will get more expensive, as it actually should be, and it could take up to a decade to recover, the so-called lost decade, which is mentioned by Ray Dalio.
Well, let me describe it this way. Achieving balance, which means diversification, is more important than ever, though it will have a lower return than before. So do you want an asset class return, or do you want a portfolio of well-balanced assets? So when I look at that, I'm saying, let's say if you take a 60-40 stock bond mix, or if you take equities, or you take any one of those things, no. I think the most important thing is to start with diversifying well. Diversification of asset classes, diversification of countries, diversification of currencies, diversification, because I think that the one thing we know is that we don't know a lot, and it's not easy to necessarily time it about what is going to happen, right? So we should be given humility. And because the markets are relatively efficient in making those comparisons, it's not like one thing is necessarily better than the other, as much as we do know that some things are better diversifiers than other things to produce whatever that excess return is, that it is as stable as possible and least risky as possible to try to achieve balance. So as we look forward, what we can say is the excess returns will be lower, the premiums are lower, but it still is better to have that diversified portfolio. It'll be a lower excess return, but it still means more stable because the individual items that make up will all have low returns, but the combination of them will make it more stable.
But Ray Dalio still thinks that having a well-diversified portfolio is the only way to keep your investing safe. What is your thought about this? Let me know in the comments below. And smash the like button because the YouTube algorithm really loves it. One other important takeaway from Ray Dalio's interview is that the money never disappears, and the wealth is never destroyed. Just the stores of the wealth can change a little bit, and we have to be very careful and observe where the money goes during and after the crisis. Okay, now we know the new environment, we know the zero interest rates, we know all of the money printing process going around, we know that we must have a well-diversified portfolio still. But what should we update on this portfolio? What is the thought of Ray Dalio about the bonds? Let us hear it.
I think the important thing to understand is that there's a real economy, and then there that has a supply demand of stuff. There's a financial economy that has its supply demand of money and credit, and that the price of an asset will equal the risk-free return, which you can see is something close to zero, and a risk premium. So when you're looking at a bond, and let's say in the United States, a treasury bond less than 1%, or if you take a corporate bond, a good quality corporate bond, slightly more than 1%, and you look at that, or you go to other countries and it's essentially zero, that is the return that investors are getting for the risk-free return. In terms of equities, you have to ask yourself, what will the premium be for equities? And the central bank has the capacity to put money in the system, and the money, excuse me, and the money competes for getting returns. And so if you ask yourself, what could the risk premium be, or what would the expected excess return for equities be over cash, and they buy assets, that number could go from 4%, let's say, to 2%. The PE is just the inverse of that. So just by way of example, you could make the PE go from 20 or 25 times up to 40 or 50 times by the demand. That may seem implausible, but that's just because people have sticker shock. But it's no less implausible than the zero interest rates. So the risk premium will be driven by the amount of liquidity put in, and multiples are not shouldn't be used as in the traditional way of a frame of reference. I think you have to understand that the capital markets drive the economy and the PEs and the risk premiums more than the real economy drives the capital markets.
So the safe investment brings 1% in return, as Ray Dalio says. Is it reasonable investing with 1% return when we have an inflation which is higher? I would say no. In my opinion, we should invest in some other asset classes which are still not so much risky, but bringing us a return with at least the inflation level. It could be an inflation fixed bond, or it could be, like in my case, a P2P lending platform which is considered safer, like Bondora Go and Grow, where I get 6.75% return on investment. So I can replace this one with the bonds on the Oweather portfolio. With that said, I must say that my portfolio is really highly influenced by the Oweather portfolio of Ray Dalio, and I'm posting a monthly updates of my P2P portfolio, but I'm gonna change this to my complete portfolio so that you can see my asset allocation and you can follow my progress with my monthly updates. Here's a link to the monthly updates that I'm posting. Thank you very much for watching. Once again, smash the like button, subscribe if you are new here, and comment below so that I know your thoughts.